Finally, we're going to move on to income tax. And all the way from week 1, we've gotten some familiarity with the income tax tables. But this is where we'll study it again. So your income tax is figured as a percentage of your taxable income. So remember, start with your total income, subtract your adjustments to get your adjusted gross income, subtract your standard or itemized deductions, and then also subtract your qualified business income deduction to get your taxable income. And now your tax is based on your taxable income. And it's not strictly a percentage of your taxable income because the tax rate is progressive. So your first approximately $10,000, if you're single, of your taxable income is taxed at 10%. And then the next about $20,000 is taxed at 12%. And then that's the first big step where it goes from 12 to 22 after that. But when you get to a new tax bracket, not all of your income is taxed at that new rate, only the amount of income that falls inside that new bracket. So let's just assume that the 10% bracket is at $10,000 and the 12% bracket is up to $20,000 or $30,000 total. Just for example purposes. So if my taxable income is less than $10,000, my total tax is just 10% of whatever my taxable income was. And if my taxable income is $20,000, then we have 10% of the first 10,000, which is 1,000, and then 12% of the next 10,000, which is another 1,200. So my total tax would be 2,200. So, which turns out to be only 11% of my 20,000 income. And if my income is, I think it's another, let's call it 50,000 or 80,000 total. If my income is, let's say, 45,000, then I pay tax on 10%, at the rate of 10% of my first 10,000, which is $1,000, and then 12% of the next 20,000, because that's the difference between 30 and 10,000 here. 12% of that is 2,400. And let's actually stop there. Let's say my taxable income is only 30,000, then my total tax is 3,400, which is still less than 12% of my total income. But now if we go on to 45,000, now I'll pay 22% of the last 15,000, which is another 3,300. So only that last 15,000 is taxed at the new higher rate. And if we add that up, my total tax is 6,700, and my effective rate, if we divide this by this, I'm still overall paying only 15%. So only the new money that fits into the new tax bracket is taxed at the new higher rate. If your income is under $100,000, that is taxable income. So we've already taken the standard deduction or itemized deductions. If your taxable income is under $100,000, we use the tax table to look up your tax. And that is so that the IRS doesn't really trust people to do complicated math, so they've done it for you and they put it in a table. So here's an example. Cliff and Kate have total taxable income of $39,974. So they look under the 39,000 block and they look for the line where they're in between the lower and higher number. In this example, they're over 39,950 and under 40,000, and they find the right filing status. That's the second column here, and they find out that their tax is 4,357.
357.
357.
Oh, okay, got it right there.
Notice at the top of the table it says at least for the first number but less than on the second number. So that means if you are right at like 30,950, you go to the next line down because it's at least 39,950. Okay, here's another example. If your income is 27,150, you find the 27,000 block in the tax tables. You find that your income is between 27,150 and 27,200. So he's right on the edge there. So we go to the second line down, and he's single, and the first line there is 3,041, the first column there. And so his tax is 3,041. And if your taxable income is over 100,000, the tax table stops at that point, and instead you have a tax computation worksheet. And all this really is, and I don't know if I can zoom in on this, doesn't look like it, is you find out which of these brackets you're in, and then you're going to multiply by your tax rate, which could be at that level of income anything between 22% to 37%. But remember that not all of your income is taxed at that top rate, at your top marginal rate, is what it's called. So there's a number to subtract to make that correction for part of your income being taxed at a lower tax rate. So, for example, Camille has 131,600 in taxable income, and her filing status is head of household. So, what's the example? Camille has taxable income of 131,600. So, and her filing status is head of household, which is going to be block D here. And that 131,600 is between 100,000 and 182,000. So we'll use the first line. And we would start with 131,600. And it says multiply by 24%. And then subtract 8,206. Again, that's the correction for part of your income should have only been taxed at 10%, 12%, and 22%. So we subtract 8,206, and we come up with 23,378. Which, even though she's in the 24% tax bracket, turns out to only be a little less than 18% of her income. So the way these tax brackets work, a lot of people don't realize that, and they're worried that they're going to get into a new tax bracket and suddenly their taxes are going to skyrocket through the roof. Like if you go from 12% to 22%, that is a pretty big jump. It's almost double. But only the new income in that bracket is taxed at that higher rate. So it's not like if your income goes up by $100 that suddenly your taxes double and you end up getting a lot less of a refund or paying a lot more in taxes than you would have if you hadn't gotten that $100. That extra $100 that you get, whether it's in your paycheck or some other type of income, will only cost you an extra $22 in taxes if you're in the 22% tax bracket. And if that $100 is enough to move you from a 12% bracket to the 22% tax bracket, that means part of your $100 is going to be taxed at the old tax bracket, and part of your $100 is going to be taxed at the new tax bracket. So it doesn't cost you more than $22.
So it's staggered.
Yeah. Okay, then this part is occasionally relevant to us, and it's called the kiddie tax. And that is the tax on certain unearned income of children. It's not so relevant to us right now, but unearned income for purposes of the kiddie tax includes a permanent fund dividend. And what this says is normally, remember your standard deduction if you have no earned income and you're someone's dependent was $1,250. And then the same amount, $1,250, is taxed at your normal tax rate. So as long as your unearned income and you're someone's dependent is less than $2,500, you just do your taxes the normal way. Take your $1,250 deduction and your tax is 10% on your taxable income. But if your taxable unearned income is more than $2,500, then anything above that is instead taxed at your parents' tax rate.
How much are dividends this year?
1,702. So with my corporation money, I could pay key tax on it.
Yeah, if it's taxable. The idea behind this was that wealthier Americans would put their investments in their kids' name to take advantage of all the unused low tax bracket space. And so Congress said, well, no, we're going to close that loophole. And even if your investments are in your kid's name, they're still going to pay taxes at your own tax rates. However, that does, anytime Congress tries to catch people in a loophole or try to close a loophole, they do catch people that it's not really intended for. So back when our permanent fund dividend was $3,600 or something like that, every child had to pay kiddie tax. And the amount over, back then it was, I think, only $1,100 times 2 is $2,200. So the last $1,400 of those permanent fund dividends were taxed at adult income tax rates. Your kiddie tax applies to you if you're under 18 or if you're exactly 18 and your earned income is less than 1/2 of your support, or if you're a full-time student between 19 and 24, and that is only for full-time students. If you're a part-time student, this doesn't apply to you. But if you're a full-time student between 19 and 24, and your earned income is less than 1/2 of your support, then your investments are subject to the kiddie tax. The kiddie tax, if it becomes relevant for anyone that you're doing taxes for, it's actually a fairly complicated form. It's Form 8615. Yeah.
86.
8615, 8615. It's actually fairly simple if it's done on Form 8814, which we do much more often, much more frequently. We talked about the 8814 already once, I think last week. But this is the parent's election to report their children's interest in dividends. And if their interest in dividends goes over 2,500, then we're going to actually fill in lines 6 through 12 here, where what it does is it's going to transfer some of that income directly to the parent's return. So it's fairly easy to have that money taxed at the parent's tax rate. We just add that to their income. But if the child is doing their own tax return, if they're filing their own separate 1040, then 8615 has to be added to their tax return. And that's a fairly complicated form. So I wouldn't expect a first year preparer to actually do that. But again, we have not very many people who have children's investments over 2,500 in income. Okay, and then the last thing we need to talk about for income tax, or computing income tax anyway, is capital gain tax rates. So qualified dividends and capital gains are taxed at a lower tax rate, long-term capital gains, that is. You might get capital gain distributions on a Form 1099 DIV. And what that is, again, is if you invest in something called a mutual fund, that mutual fund itself buys and sells shares of stock. And if it sells stock and creates a long-term capital gain, it has to pass that long-term capital gain onto the mutual fund owners. So that's a capital gain distribution. That's treated as a true capital gain. It combines with any other capital gains you have. And your qualified dividends, even though they're taxed at the same rate as long-term capital gains, are not actually long-term capital gains. So they don't combine with your other long-term capital gains for, you can't offset it with a loss. So qualified dividends and capital gain distributions and long-term capital gains are taxed at a lower tax rate. And the basic idea is if you are in the 0%, if you are in the 10% or 12% tax brackets, your capital gains tax rate is 0. If you're in the 22, 24, 32, or 35% tax brackets, your capital gains and qualified dividends are taxed at 15%. And if you're at the very top tax bracket, 37%, your capital gains are taxed at 20%. That's the basic idea, but there's a slight difference between the top of the 0% capital gains tax bracket and the top of the 12% ordinary income tax bracket. And my belief is that is just because there was a typo in the law. It was off by $25, and because of inflation, it's now up by $50 or $60. But we have to go by the law as it's written. So this is kind of what we're stuck with. There are also in this table where we have 3 special types of long-term capital gains that are taxed at different tax rates. And these 3 are collectibles. Remember, you can have a capital gain on anything that you sell for more than you bought it for. We're not always talking about stocks or bonds. So collectibles would be things like jewelry, artwork, comic books, baseball cards, collectible game cards, anything of those that you buy for more than you sold it for. you're taxed at up to 28%. So it's taxed at your normal tax rate, but if your normal tax rate is more than 28%, then you instead only pay 28%. So to get any benefit for long-term capital gains on those collectible sales, your tax rate would have to be 32% or higher. Collectibles also include precious metals. This one, eligible gain on qualified small business stock minus the Section 1202 exclusion, is a mouthful. That's pretty rare, but what that means is if you invest in a small business, and I won't go into the definition of what a small business is, but if you invest in the stock of a small business and hold that stock for at least, I believe it's 5 years, and sell it for a gain, you can exclude half of your gain completely from tax. But the other half is taxed at up to 28%. This has only come up for us once or twice, where a father bought into his son's company, invested $50,000. The company actually improved, and the son bought back the stock for $300,000, and half of that $250,000 gain is tax free, and the other half was taxed at his normal tax rate. And unrecaptured Section 1250 gain is a type of long-term capital gain. And that is something that comes up quite frequently. What that is depreciation on real estate. Any gain that results only from depreciation on real estate is generally unrecaptured Section 1250 gain and is taxed at your normal tax rate up to a maximum of 25%. We'll talk more about how depreciation affects your gains or losses when we get to the chapter on depreciation. Okay. We can skip the examples, and then we'll come to the final part of this chapter, which is, do you have an overpayment or an underpayment? So you compare your total tax with your total payments, and if your total payments are more than your total taxes, you have an overpayment, and you have the option of having that refunded to you or carried over to next year's tax. Most people, I'd say 99.5% of our customers, want that refund. If you owe, if your payments are less than your tax, then you have an underpayment or a balance due, which means you have to pay that by April 15th if you want to avoid any interest or penalties. One of the later chapters, 17 or 18, I think, will talk about what to do about underpayments if people can't pay them by April 15th. We can get installment agreements or other resolution possibilities. And that finally ends this chapter.